What if I told you that the stocks most likely to build long-term wealth are the ones nobody's talking about? No flashy headlines, no sky-high growth projections, just quiet, consistent performance, year after year. In this video, we're diving into the secret power of boring stocks and why the most successful investors rely on them far more than you think. And if you're tired of chasing hype and losing sleep over volatility, this might just change how you invest forever. So what exactly do we mean by boring stocks? These are companies that don't make headlines because they don't need to. Think waste management companies, utility providers, insurance firms, consumer staples like toothpaste and laundry detergent, and dividend-paying industrials. These businesses are often called defensive or low-volatility stocks. But the real truth is, they're cash machines with durable business models. They don't rely on speculative technology, rapid user growth, or moonshot innovations. They just operate with consistency and deliver value quietly. They've been doing it for decades, and that kind of longevity tells us something important. Let's compare to fictional investors. Investor A chases the latest hot stocks, AI startups, biotech moonshots, EV disruptors. Some explode upward, most crash and burn. Investor B, meanwhile, sticks with steady dividend payers in healthcare, utilities, and consumer goods. No hype, no drama. Tell 10 years Investor B might not have made headlines, but their portfolio likely looks stronger. Higher total returns through consistent compounding. Lower volatility, which means fewer emotional decisions. And most importantly, peace of mind. This is the power of consistency over chaos. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. Boring stocks reward the patient. Let's talk real-world examples. Procter & Gamble. You use their products every day. Tide, Gillette, Pampers. But the stock? It's delivered consistent returns and dividends for decades. Waste management, yes, literal garbage, has quietly turned into one of the most stable growth machines in the market. Johnson & Johnson, boring? Sure, but it's also one of the most reliable dividend-paying stocks in history. PepsiCo? Not just soda, they own snacks, beverages, and brands that people consume every single day. These are companies that don't rely on social media buzz. They rely on habit. And habit is one of the most powerful forces in human behavior. Now, let's get into why boring stocks win quietly over time. First, reliable cash flow. These businesses generate stable income regardless of the economic cycle. That cash supports dividends and reinvestment. Second, stable business models. Their demand doesn't fluctuate wildly. People need food, healthcare, and electricity, whether the market's up or down. Third, low volatility. This reduces panic selling, emotional reactions, and poor timing. And fourth, dividend reinvestment. This is the quiet engine of long-term wealth building. Reinvested dividends compound your returns far more than you might think, especially over decades. So why doesn't everyone just invest in boring companies? Because we're human. We crave excitement. We want to beat the market, not just match it. We confuse volatility with opportunity. We overestimate our ability to time the market. The result? We chase hype, get burned, and ignore the slow but steady winners. But the best investors, people like Buffett, Peter Lynch, even institutional money managers, know this truth. Long-term wealth is built quietly. It's not about finding the next big thing. It's about owning the right boring thing for a very long time. If you're ready to embrace boring, here's how to identify the good ones. Consistent revenue and earnings growth, strong dividend history, a wide economic moat, meaning the company has competitive advantages that protect its profits, low debt and strong free cash flow, and simple, essential products or services that people keep buying no matter what's happening in the economy. As a bonus, look at dividend aristocrats, companies that have increased their dividend payouts for 25 consecutive years or more. These are usually boring, and brilliant. So let's build a sample boring but beautiful portfolio for the long term. Not financial advice, but these are the kinds of names that fit the profile. Procter & Gamble for consumer staples. Johnson & Johnson for healthcare. Waste management for essential infrastructure. PepsiCo for food and beverage.
Xterra.
Energy for utilities, with a green energy twist. And maybe a broad dividend ETF like the Vanguard Dividend Appreciation ETF, VIG, to round it out. Hold them. Sleep well. The secret power of boring stocks isn't just about avoiding risk. It's about clarity, patience, predictable compounding. It's about removing the stress and noise from investing and letting time do the heavy lifting. While others chase trends and react to every market swing, boring stocks just keep working. They're not sexy, they're not explosive, but they're exactly what you want if you care about real, lasting wealth. So next time you see a company that looks too boring to buy, take a second look. It might be the smartest decision you make. If you found value in this video, give it a like. It really helps the channel. Leave a comment and let me know. What's the most boring stock you love? And don't forget to subscribe for more clear, unfiltered investing insights every single week, right here on Market Pulse Unfiltered.